Do you want income that lands in your bank account every month, even when markets are flat and rates are falling? A laddering strategy can give you steady, predictable cash flow from low-risk or income-paying assets. Instead of putting everything into one investment, laddering means splitting your money into smaller parts, each maturing or paying out at different times.
Laddering happens when you have a sum of money and then you break it up into multiple components and deploy them at various times across, say, a time frame of a year or so that you can create staggered returns.
This means you don't wait a full year or more for returns. Money flows in regularly. You can build ladders from a mix of assets, short-term bills, government bonds, or dividend stocks. The goal is steady payouts that you can use or reinvest every month. You can choose your own risk level, from safe and slow to higher yielding options. The lowest risk ladder puts safety and liquidity first. You can start small. $1,000 split across 12 Singapore savings bonds or SSBs over 12 months builds a mini ladder. You start receiving your first payout in month 7. After that, the payouts will come every month as each bond's 6-month interest kicks in. Financial advisor Elijah built his own ladder when rates rose in 2022, one Singapore savings bond each month.
I bought multiple SSBs and they're all laddered in such a way that right now, every month, I'm actually getting a payout from 1 or 2 different SSBs. So if you have 20,000, you split it up over 6 SSBs, the next 6 SSBs, and assuming the rates are the same, okay, then we are looking at about 1.35% return over the first year. So you could expect $270 on your SSBs after 1 year. That's something like $20 a month. If you scale out the quantum, the returns you see from a ladder will of course scale out proportionally.
It's simple, low maintenance, and government-backed. But the trade-off? Low yields. The latest tranche offers a 1-year interest rate of 1.39%. If you can take a little more market movement, a balanced ladder mixes bonds, ETFs, and REITs. This blends stability from SSBs and T-bills with moderate market exposure. You can potentially triple your yield without taking full equity risk.
Fixed income portfolio, you'll be around 1.3 to 1.5%, mainly on the T-bill and SSB. The balanced portfolio, 60-40, you'll be around 3.5%. And for the equity dividend portfolio, it'll be between 4 to 5%.
Each rung serves a purpose. Short-term bills for steady cash flow and liquidity, bond funds for stability and moderate yield, REITs and dividend ETFs for higher income and potential capital growth.
Low yields come with a trade-off. It's capital guarantee if it's an SSB ladder, but if you go to say a equity ladder, you have equity exposure and therefore risk.
The idea is to balance safety and growth, so your portfolio can weather different market conditions while still building wealth over time. For investors comfortable with volatility, a dividend ladder uses REITs, bank stocks, and multi-asset income funds. Each pays at different times, so with proper planning, you can receive cash flow almost every month.
Once you set up the whole strategy right, you can let it auto-run for the dividend.
It requires discipline and monitoring, but a 5% yield can generate about $2,500 a year from a $50,000 portfolio. Those payouts can grow as companies raise dividends over time. But investors should note that companies can also change or even pause dividends. That's why it's not just about yields, but also consistency. Cash flow is dependable, and you can actually use it.
Cash flow products, reasonable cash flow, you can expect anywhere from 3 to 5%. It will not be exciting. Growth stocks, in a good year, you can get 20% growth, 30% growth, right? But that's not cash flow to you. $10,000 top up into CPF SA may generate $400 of interest, but that interest you can't touch it. But if $10,000 into a 3% SSB, for example, will generate $300 of coupon payouts. That $300 is going to come to you, into your bank, and you can touch it.
Whatever ladder you build, discipline is key. Remember to reinvest each rung when it matures. Skip one, and your ladder breaks down.
Every time your asset matured, you need to roll over to the next cycle. For example, T-bill, 6-month T-bill, you have to roll over every 6 months. Right? For a 1-year T-bill, you'll be every 12 months. If you're not disciplined, basically the whole strategy will be broken halfway.
Many investors automate this by tracking dates on a spreadsheet or setting reminders to reapply for each issue. You can start laddering regardless of market conditions. And if there are better opportunities, you can use the cash to buy other assets.
When there's a market correction, you are able to immediately use the cash and also invest in the market to capture the low price. And also, hopefully, moving forward, you can capture the market upside.
It is a journey. You will not start with 20,000 and magically have enough cash flow to retire yourself. I've added my portfolio over the past decade. Today, I think I'm doing okay. I'm generating 4 figures of cash flow from my investments every month. Just the yield component alone. Low 4 figures, it's not enough to retire, but it is a comfort knowing that I can use that to pay my bills and such.
Whichever ladder you choose, the goal is to get steady cash flow that you can count on, while your money keeps working one rung at a time.